I would say that the economy's improved. I think people feel comfortable that things are stable. We're probably 4 or 5 years into a 10-year journey on the regulatory front. I think firms are genuinely concerned about the political environment and what that could mean ultimately to the regulation. And I think they're all working their way through the many different binding constraints that they see as the future for their business in terms of managing outcomes in the future. Yeah, I think you've seen the banks have been building capital over these past 4 or 5 years. I think they all feel like they are strongly capitalized in this environment. I also think that they've taken liquidity largely off the table because of being forced to carry so much liquidity. It's a big cost in the business. I mean, one of the biggest challenges that they have is in this interest rate environment, liquidity is a burden. Carrying liquidity is a burden. And when you're carrying maybe a bit too much capital and a bit too much liquidity, it puts a lot of pressure on earnings. And so that's what you're seeing. The stress test outcomes are going to be interesting. So the asset quality review in Europe, the results of the CCAR process that were just published this week in the US, where 5 institutions failed, and only one of them quantitatively, interestingly, 4 of them from a process perspective. And this is interesting because this is our relevance to our clients is strongest in the areas of controls and managing regulation. These are opportunities for us to be helpful to our clients. And in the end, the banks are being judged not only on their capital strength and the liquidity strength, but the fact that they can document, control all the processes around that to be able to feel very confident that they're getting the results from the actual facts that are driving their business.